Holy smokes, everyone. The market absolutely melted up today. We saw a rip your face off rally, and many people are starting to ask the question, well, okay, are all our problems gone? Are all the worries in the economy gone? Are all the worries in the job market gone? Are all these companies that are laying off thousands of employees? Are all these companies that are collapsing, going bankrupt? Are all those problems now gone, and now's the time for stocks to go to the moon? Well, everyone, that's exactly what we're going to go over in today's video, because I'm sure there's a lot of new investors. They see market go up and they get the FOMO. They buy high, and then when the market crashes, they sell low. Unfortunately, many people would think, no, that's the most stupidest thing to do, but that's what a lot of these new investors do. They get pulled in by these bear market rallies, they get trapped, and then the big money comes in and dumps on them. So why did the market rally today? Is this going to continue? And is a market crash scenario still on the cards? Well, everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, everyone, let's have a look at the indices today. So look at this. The Dow rallied 1,200 points. The S&P was up 5.5%. And the Nasdaq, the tech sector, up 7.3%, with Russell 2000 up 6%. When I woke up this morning in Australia time, I looked at the markets and I thought I was looking at cryptocurrency for a second. This is an absolutely huge rally. So what exactly did get the market so excited today? Well, that was the latest CPI report. The latest CPI report came in lower than expected. And I was actually looking at these economists' estimates and looking at these mainstream media news analysts. They were actually expecting inflation to come in hot this month at 0.6%. And I was thinking, why would they think it's going to come in hot? It was already hot last month. And normally with CPI, it compounds on top of each other. So if you have a high month, normally the next month is lower. So what I think this was the mainstream media, these market analysts trying to fuel a market rally. They were trying to say, well, look, inflation's going to be really high this month. So then that way, when the inflation number came in and seemed not that bad, we saw a huge rally. But people, what happened with the CPI is it was still 0.4%. Now, when you annualize that, that is nearly 5%. That's 2.5 times the Federal Reserve's mandate. So if you think a Federal Reserve pivot is going to be coming soon, it is time to think again, everyone. And this is what the market is praying for right now. They're living on hope. We see this again and again after every single CPI release, after every single Federal Reserve meeting. We see the pivot time has come in. They try to cause a market rally, and again and again and again, the Federal Reserve has come out and reiterated, no, we're not going to pivot just off 1 month's piece of data. We need to see inflation come back down substantially to our 2% target. And people, inflation is still 7.7%, so they're nowhere near a pivot at all. But there's a lot more behind the scenes and underneath the hood that caused this market rally and the technicals. So let's have a deeper look, everyone. Look at this, S&P 500 rockets towards best CPI day since 2008 on Fed optimism. So why people may think these kinds of moves are good or they're healthy, no people, these moves are very, very unhealthy indeed, and is a sign there is illiquidity in the markets right now. And do you know when the markets have had their best ever days? The best ever days in the markets are right in the middle of the biggest bear market crashes. So why people may think, oh, this is great, the market's had its biggest rally since 2008? Well, what happened in 2008? That's right, the S&P 500 crashed nearly 60% and we had a huge financial crisis. So be careful what you wish for. Now, another thing investors I think are getting wrong is they're confusing what a Fed pivot actually is. They're saying, well, look, the Federal Reserve's only going to lift interest rates by 50 basis points or 0.5% in December, so that's a pivot. No, that's not a pivot. They've told us time and time again that this has been their plan all along. This is nothing new. They said they're going to do 75 basis point hikes. They did 3 of them in a row, and they said they will slow down the pace of rate hikes, but the final destination is going to be higher than they first expected. And they're now saying they may have to go above 5% if inflation doesn't drop back down to 5% very, very quickly. Now, another thing that caused a market rally today was the DXY. This is a DXY, the US dollar index. Now, very simply, for those that don't know, when the dollar goes up, assets price in the dollar goes down. But when the dollar goes down, assets price in the dollar tend to go up. And we can see here, it crashed when we got this CPI report, and it fell over 2% from around 110 all the way back down to 107. And it wasn't just stocks that rallied. Gold soared over 2% and also silver went up as well. Gold is now at $17.50 and silver is almost $22 an ounce. Cryptocurrency had a bounce but is still in a downtrend. Bitcoin rebounded up to 17,300, but this still is, a new low compared to what it was a couple of months ago. So we are still in a downtrend for cryptocurrency. We can see Ethereum is back up to 1,200, but I do expect we're going to see lower lows with cryptocurrency as FTX has to liquidate their assets. And the 10-year US Treasury yield dropped as well to around 3.8%. But let's have a deeper look at this CPI report to see what is rising the most right now and what is actually falling. Okay, everyone, this is a CPI report. Look at this. Food is still up 0.6%. So this is still going up much faster than the Federal Reserve's target of 2%. When you annualize that, that's 7.2%. Energy is still up a lot, and I expect this is going to continue to rise. Look at this. This is up 1.8% just this month alone. Again, when you annualize that, that's nearly 20%. Look at this. Gasoline, all types, up 4% in just 1 month. Fuel oils up 19.8%. Now, something that did fall was energy services, down 1.2%. And the item that had the biggest declines was utility pipe gas services, down 4.6% in October. We're seeing new vehicles continue to rise, up 0.4%. So again, that is higher than the inflation target. But like I kept warning about the used car market, look at this, everyone. We just saw the biggest decline this month so far for used car and truck prices, down 2.4% just this month. So if you're in the market for a car right now, I'll definitely wait on the sidelines. You're going to see some great deals coming soon. Apparel down 0.7%, but look at this, shelter up 0.8% and transportation up 0.8%. So again, even though the CPI is saying it's just 0.4%, no, for many people, the cost of living is rising up much, much faster than that. And really, it is more like double or triple the official government figures. Now, times we also see huge rallies like this is when there's something called a short squeeze. People short the market when the market is crashing. People buy lots of puts, but when the market reverses, these people get squeezed and they have to cover their positions and buy these stocks up. And that combined with all the other factors I said right now is causing this violent rally. But again, the question you're wanting to know the answer to, will the rally continue? Did we miss the bottom? Or will this market crash be about to get much, much worse? Well, everyone, first things first, something people aren't really talking about is the Federal Reserve's balance sheet. They started something called quantitative tightening. That's when the Federal Reserve starts selling off their balance sheet and starts selling off their assets. We can see here it hit a peak of around 8.9 trillion and has now fallen all the way down to 8.6 trillion. And the Federal Reserve has not made it clear how much they're going to have to sell off to bring this inflation down. But I expect they're going to have to sell at least $2 trillion worth of assets, and that's going to have continual pain for the markets, whether they lift interest rates or not. But the single biggest decider that will tell us if this market will continue or not is what will happen with inflation. And people, I've done some digging, and I've looked at history to see what happened with inflation to give us some ideas of what could happen in the future. Because the further you look in the past, the further you can see ahead in the future. Now, look at this, everyone. This is the time period of the Great Inflation. Now, what we saw on this chart here was we saw in mid-1960s, inflation started to surge. We saw here it hit a peak here, the first peak in 1970s of around 7%. Then it dropped a bit and people were thinking, oh, okay, inflation's over. But no, then it skyrocketed again in the mid-1970s to over around 12-13%. Again, then it dropped. And then it surged to a new all-time high in the 1980s to nearly 15%, and the Federal Reserve had to lift interest rates to 19% to bring this inflation down. So again, when we look at this chart here, this tells us that inflation doesn't just go up once and then goes back down. This chart tells us here we see waves with inflation. It will go up a little bit, but higher prices cure higher prices. Prices begin to fall. The Federal Reserve and central banks may start to loosen their monetary policy. People start to speculate in the market to think that the interest rate hikes are over. And then we see inflation surge again. Then prices get too high, they drop a little bit. Then people get a bit of hopium again, start getting the market, central banks start loosening things, and then we see inflation surge higher again. So where we could be right now in this new multi-decade high inflation environment, we could be in this period here of the mid-1960s, and this could just be the first round of inflation. We may see a bit of a drop-off, but like we're seeing in the markets, then we're going to see a melt up, and then we're going to see inflation surge again. So what you need to know is, even if inflation does drop, what's going to happen is the central banks are going to loosen their monetary policy. then we're going to see a speculative frenzy like what we're seeing now. There's huge amounts of money waiting on the sidelines, waiting for the Federal Reserve to pivot. They're going to come in, buy up the dip. It's going to cause huge inflation, and people will think this is time to get back in the markets, but then inflation is going to surge higher, and the central bank is going to have to come in and smack inflation down even harder. And like it showed in that chart, it took decades, not 1 year, not 2 years, for inflation to drop back down to its 2% target. So all these people thinking that the Federal Reserve is going to pivot next year, inflation will drop back down to 2%. No, it is not going to happen, everyone. Also, what I expect to happen next year is oil prices are going to skyrocket again, because right now what we've had artificially low oil prices by the US government draining their strategic petroleum reserves. But they're going to have to refill them next year and going to have to pay a much, much higher price. This is going to make energy prices, gas prices, oil prices to skyrocket, and that is an input cost for all businesses. But let's play devil's advocate here, and let's say, okay, the Federal Reserve does halt its interest rate hikes. Remember, people, they're going to halt first before cutting. They're not just going to go from hiking to cutting. Let's just say, okay, they do halt interest rate hikes. Well, even if they do halt interest rate hikes, we have still lifted interest rates from 0 to what will be in December, 4.25%. This is still the fastest rate hike increase since the 1980s. And because there's so much debt in the system right now, even 4% interest rates is going to be enough to crash the economy and to crash these companies. Because I'll show you in a moment what's happening with this corporate debt market and what's happening with consumers right now. And this is going to lead to companies' earnings tanking. We're already seeing it now, but it's going to get even worse in the fourth quarter. Look at this. A market-to-market massacre is claiming a $10 trillion market. And what market is that, everyone? That's the corporate bond market, aka corporate debt. Look at this chart here of a market value of a hypothetical long-duration bond portfolio. We can see here it has crashed 34%. So a $1 million portfolio has fallen all the way to $650,000. So while people are focusing on the stock market, the bond market is actually crashing much, much worse than the stock market. And this is going to cause significant pain for all these corporations that use corporate bonds. They issue these corporate bonds to fund their investments and to fund their spending. We're seeing companies collapse like FTX, a lot of cryptocurrencies collapsing, and we're seeing big tech giants like Facebook, Twitter taking huge, huge losses as well. The portfolio contains 30 bonds covering 10 major sectors ranging from technology to utilities, energy and financials. They're all rated investment grade by major credit rating agencies. There's no junk here, and the vast majority were trading near 100 cents on the dollar as early as January. They are bonds issued by well-known companies like Facebook Corp, Amazon Inc., Coca-Cola, and the type of debt that would be found in an average investor's retirement portfolio. So that's right, everyone. Normally what happens in retirement portfolios, as you get closer to retirement, these funds put people's assets in less riskier, what they think are less risky assets like bonds. But we've seen US treasuries, they've crashed, and we're seeing corporate bonds crash right now. And this is going to cause retirees to see their portfolios absolutely tumble, and they're going to tighten their belts, and they're not going to be spending much at all. The party line is always, if you hold them, you'll get your money back, and that's true. But the issue today is people buy fixed income for a reason, and now you're running into a situation where your costs are going up, but your fixed income is the same. Hopefully you won't need to sell any portfolio at such a painful discount to cover those increased costs. So that's right, everyone. Why some people may say, well, look, you don't have to sell it and you can get the full principal back when the coupon matures. But inflation is skyrocketing and people need extra money right now to keep up with the cost of living. So some people may be forced to sell these, and some companies that are facing higher borrowing costs may be forced to sell these to keep up. Again, another indicator, even if the Federal Reserve stops lifting interest rates, there is already huge pain happening in the debt markets, and consumers have been forced to pile on debt to keep up with the rising cost of inflation. Look what's happening to the average consumer right now. It ruined everything. Buy now, pay later drives Gen Z into debt. So there's a story here of an average consumer. She's 18, she saved up $16,000 for her first home, but then she got into huge amounts of debt with these buy now, pay later schemes. People have just been spending, saying, don't worry, live now, treat yourself. But now she's racked up $5,000 in debt and it severely hurt her credit. And what's happening is a lot of other consumers are in the same situation. They're using these buy now, pay laters just to buy their groceries. That's how bad things are getting. So again, I ask you the question, do things look better now than they did last month? No, people, the real situation is actually worse. But the markets, they rely on hope, they rely on things maybe changing in the future, and they're all relying on Federal Reserve to keep that cheap credit coming because they're all addicted to the money printer. But I have not changed my prediction at all. I expect over the coming week these gains to be erased, and I expect to see the Federal Reserve chair people come out and say, no, we're going to have to continue to fight inflation, or no, we're still going to have to lift interest rates a little bit. And I think next year, the Q1, we're going to start to get this data of what these higher interest costs are doing on companies. Because again, they've gone up so fast, we haven't even got the data yet to see the impact these high interest rates are having. And like I said, companies' earnings are going to fall in Q4, and stocks are priced on companies' earnings. So if their earnings fall, like what we saw in Facebook when they announced that their revenue dropped in half, well, we saw their stock collapse 25% in just one day. And this is going to happen to more and more companies next year. But everyone, what do you think? Do you think the market's going to rally from here? Do you think we missed the bottom? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.